Hey, this is Yossi from a small investment firm that specializes in REIT investing, and today I'm going to discuss how a major potential tax hike could soon impact American dividend stocks, including REITs. But before I get into it, I wanted to remind you that we just recently launched a new fundraiser to buy 5 fully equipped trucks that we will deliver to Ukrainian frontline units in July. The fundraiser is going really well. We've already raised 80% of our targeted amount, so let's finish this strong. If you want to learn more about this fundraiser, please click the first link in the description of this video. Okay, so let's get straight into the video now. I'm referring here to the big, beautiful bill, as the Trump administration calls it. It's so big, in fact, that it has a hidden potential tax hike that's been overlooked by most people because this bill has so many different topics. This one appears to have gotten overlooked, and yet it's very important. I'm here referring to the section 899, which essentially gives the executive branch the authority to potentially significantly hike taxes on foreign investors investing in American equities and fixed income. And here, if you're a US-based investor, you may feel some sense of relief thinking that this won't impact you, but keep watching, you'll soon understand why this matters to you as well. And so to be more specific, this section targets countries that are deemed to have unfair taxes on American companies, and so it retaliates on those countries by potentially imposing higher taxes on the individuals, corporations, and other entities of that country. And so, to give you an example here, if President Trump deems that the digital service tax of the European Union is unfair to American companies like Google, Apple, and so on, then it could retaliate on the European Union by imposing higher dividend withholding taxes on all the US dividend stocks owned by European Union residents. And the tax hike would be quite significant. The section imposes a progressive additional tax. In the first year, they could increase it by 5%, the tax rate. Then in the following years, they could again each year increase it by another 5%, capped at a maximum of 20%. But keep in mind that the US is already imposing 15 to 30% withholding taxes on dividends, depending on the country in which the investors is residing. If you now add to this 15 to 30% an additional 20%, that will be very significant. And the reason why this matters to American investors as well is because today about 20% of US stocks are owned by foreigners. And therefore the demand for American stock by foreigners is having an impact on the market value of these stocks. If suddenly the demand goes down because these foreigners are getting hit by tax hikes, then the share price of US stocks will drop. And as their share prices drop, their cost of equity goes up since their multiples contract. If the cost of capital goes up, then the growth also slows down, which again hurts returns. And then perhaps if growth slows down, this is going to hurt the market sentiment even further, again leading to a declining share price. And so this risks ultimately crashing the market. And it doesn't stop there. It could also hurt the value of the US dollar. And we saw this as President Trump started the trade war. It led to a sharp drop in the value of the US dollar. If now they do the same by also weaponizing the taxes on foreigners, it could lead to a further deterioration in the value of the US dollar. And another potential negative consequence of this is that foreign countries could now also retaliate, just as they did when Trump announced those major tariffs. They imposed similar tariffs themselves. If now the Trump administration is greatly increasing the taxes on foreign investors and foreign corporations, we could see these foreign countries do the same. And today, about 40% of the profits of US multinationals are earned abroad, so the impact could be quite significant. And there's one more potential negative consequence of this, and it's that this section 899 also applies to the interest income earned by foreigners. And historically, foreign investors have been critical to financing the US deficit. I mean, they own about 30% of American treasuries today. And so if the big, beautiful bill goes through, this will significantly increase deficit spending. So we need these foreigners to finance a portion of it to keep interest rates low. But if now suddenly they are less interested in buying American treasuries because they're getting hit by higher taxes or fear that they might be, just a fear is enough to lower the demand. So this could lead to higher interest rates, again further hurting the American economy, their companies. In my opinion, this would be very bad news. And so here you understand why this doesn't matter just to the foreign investor who's getting hit with a higher tax rate. It also matters to the American investor because this has many indirect consequences that could end up hurting American dividend-paying stocks. And unfortunately for us on this YouTube channel, we focus on REITs. REITs generate more dividend income than the rest of the market, and therefore they could be even more heavily impacted than the average. That's at least what many investors appear to think, and that's why I've probably received many messages from you asking for my thoughts on this topic. While I agree that this all sounds really bad, I'm actually not that worried, and here's why. First of all, I think that this bill is unlikely to go through without some major adjustments, and you've seen it in the news. There is a very big public fight now between Elon Musk and President Trump. I've filmed a separate video on this topic that you can watch by clicking the second link in the description of this video. But in short, I think that this is going to lead to a growing divide in the GOP, possibly a policy gridlock now, and so I think that this whole bill is going to have to be rewarded very significantly, since President Trump was in big part elected in order to bring government spending and deficit under control, and yet this big beautiful bill is set to increase an already high level of deficit. It would increase it by several trillions in the coming years. According to Elon Musk, it would bankrupt the United States quite literally. I don't know if it's the case, he's probably exaggerating here, but I think that it's going to face more and more opposition, and we're already seeing some Republican senators now oppose the bill, and I think that this is unlikely to go through. But even if it went through, the tax hike actually isn't as significant as it may first seem. And yes, I've also seen those scary headlines talking about, they all focus on this 20% maximum hike. But what you need to remember here is that it's a 5% increase in the first year, and another 5% in the second year, another 5% in the third, and the fourth. And so I think that what this essentially means is that, first of all, even if they hiked it by 5%, you end up with for most countries in the European Union, they have a 15% withholding tax for US dividends, so you will go from 15 to 20. But according to their tax treaties between most European countries and the United States, you're able to use this withholding tax as a tax credit in your home country. And so even if it goes from 15 to 20, the impact might be zero in the end, because you're probably paying more than 20 in your European country where you're living anyways. And so you're getting now a tax credit for the 20, and you're paying something additional probably still anyways in your home country. So the net impact is actually zero in that case. And since it would take many years to reach the maximum of 20%, since it's a 5% additional tax rate every year, I think that what this implies is that this is really used as a negotiation tool. Just like with the tariffs, President Trump set very high tariffs with the goal of then negotiating them down by getting some concessions from foreign countries. I think it's the same here. He will threaten by putting an additional tax perhaps on these withholding taxes, but then they will go back and negotiate with these foreign countries to try to get some of their taxes down, and so I don't think that this is something that will remain permanent. I mean, Trump is in power for another 3 years anyway, so we wouldn't reach the maximum of 20% even by then anyways. And finally, it's important to remember that we expect the bulk of the returns from the REIT sector to come from capital gains rather than dividends in the coming years. And that's because REITs have now gone through a 3-year-long bear market. They're priced at historically low valuations. And our thesis for investing in REITs today is exactly that. They are discounted. We think that they will recover in the coming years, leading to significant upside. And therefore, we think that most of the returns will come from upside. And this is not impacted by these taxes in this section 899. These taxes only impact the dividend, which is expected to be a minor portion of the total returns. So ultimately, I mean, this is not good news. I think it's bad news, but the impact is not as significant as it may seem. Most likely the impact is going to be zero, because I don't think that this bill will go through. But even if it does, it will still likely be zero, because you'll get a tax credit in your home country. And even if it's not zero, it's likely to be then minimal, because again, we're talking about 5% in the first year. The next 5% will come only in the second year, again, leaving time for negotiations. And as we've seen with this administration, with tariffs, they can change their policy, the tax rates, from one week to another completely. And I don't think that this will be different. A final interesting point I want to make here is that when I started my career, my first employer, who I consider a mentor for me, he taught me that you should never invest based on taxes. And he had in his life seen a lot of investors make investment decisions primarily based on how much they will be taxed, and in his opinion this is a mistake. I mean, he had seen it through his investment career that, you know, people want to pay as little taxes as possible, but often this will then lead to irrational decisions favoring investments that, yes, result in a lower tax bill but end up earning also lower returns in the end. I don't think that this is ultimately going to have a major impact on the long-term performance of REITs, and therefore I don't think that you should base your investment decisions on this noise. If you think that REITs are undervalued today like I do, then you probably shouldn't change your long-term strategy based on this single factor. At most, you may want to seek a bit more geographic diversification, and that's what we do at High Yield Landlord, which is my REIT newsletter. We have an international REIT portfolio, and so we're not just investing in American REITs, we're also investing in European REITs, Latin American REITs, Asian REITs, we even own one African REIT, and so you get to greatly improve the risk reward of your portfolio by investing in real estate throughout the world. Don't just invest in one country and then be dependent on its government for policies, changes in taxes, changes in interest rates. I mean, you can, of course, but I think that you could do better in terms of your risk reward if you spread out your investment elsewhere. And if you want to access our full portfolio, you can join us at High Yield Landlord for a 2-week free trial. It will be one of the links in the description of this video. Thank you very much for your interest. Please consider clicking the like button, subscribing to our channel if you thought that this was interesting. See you at my next one. Bye-bye.